We've had a good amount of housing data out of the US so far this week, which should help us gauge what kind of condition the US housing market seems to be in at the moment. Joining me now is Yelena Shulyatyeva, US economist at BNP Paribas in New York, whose area of expertise include the US housing market. Yelena, thank you very much for joining me. Now, before we go on to discuss the housing sector in more detail, what do you make of the most recent data we've seen on the US housing sector?
Well, I think the recent housing data is a reason for optimism. In fact, housing continues to improve, and forward-looking indicators lead us to expect a 0.5 percentage point contribution from the sector to GDP growth next year. Existing home sales in October beat expectations. The month's supply of homes on the market fell to the lowest level since 2006, suggesting that inventories are well back to normal levels. Home builder sentiment also beat expectations, and housing starts too. The improvement is consistent with our forecast for housing starts to rise to above 1 million level by the year end next year.
Well, the data seems to be painting a more encouraging picture of the US property market, with sales helped along by record low mortgage rates. But how to move forward with this recovery? What obstacles are preventing an even stronger rebound in the residential real estate?
Despite mortgage rates hitting record lows, mortgage applications for purchase have been essentially flat for several years, and home ownership rates continue to decline, hitting levels not seen since 1997 and having more room to decline. Virtually all new household formation is going to rental housing. The number of owner-occupied housing units is still more than 2% below its peak and appears still to be on a downward drift. Existing homeowners are also more cautious than in the past. Consumers are no longer eager to trade up or house hop. Mortgage debt outstanding has been on a constant downward trend since the financial crisis began in 2008, as households seek to deleverage and rebuild home equity. So far, the Fed's aggressive monetary interventions have been powerless to stop these trends away from home ownership and housing leverage.
Discussing efforts by the Federal Reserve policymakers, do you think the bank's overly tight lending standards are preventing further sales and naturally the recovery of the US economy?
I agree with that, but the lack of demand for housing is not purely a function of credit constraints. While mortgage standards are indeed much tighter than during the housing boom, interest in home ownership appears to have declined. We have long held the view that much of the lack of demand for housing is probably a structural phenomenon, and lending standards here are not a constraint. In fact, the Fed's aggressive policies have depressed yields on safe assets to the point that solid nominal rental yields are quite attractive. And thus, Fed policy is finally reaching housing, albeit through a less conventional channel. So lending standards are tight, but at the same time, monetary policy is making its way through, and it's working.
What about home prices, purchases and demand in different regions across the country, and even the impact and disruption on the market caused by Hurricane Sandy?
Well, housing prices was the biggest economic upside surprise in the first half of the year. You know, the stabilization in home values can have a powerful impact on the economy through increasing consumers' confidence in their balance sheets and potentially leading to an easing in bank mortgage lending standards as lenders gain confidence in the value of underlying collateral. Regional evidence from existing home sales reports indicates that the largest house price increases are being recorded in the West, and they are more than double the average pace of house price inflation nationwide. More permanent structural changes in local economic activity brought about by the recession imply that other cities such as cities in the Midwest, prices will probably never return to their pre-bubble trends. So indeed, regional differences are very dramatic. In terms of the Hurricane Sandy, I think we could see a temporary effect on prices in the Northeast, although it's not clear how lasting these effects will be.
Finally, Yelena, if housing is cheap, borrowing costs are cheaper, is now a good time to buy?
Indeed, it really depends on what your goals are. So if you are buying a house for yourself and are planning to live there for a number of years, I think it's a good investment, because it's a good opportunity right now, because indeed housing affordability levels are hitting historical highs. Rates are so low and prices probably have bottomed out, so why not? It's really the time to buy. But at the same time, if you are thinking, okay, maybe it's another trend and I can hop on and try to make money out of it maybe in a couple of years, maybe it's not such a good investment. It's really a dangerous situation, and we all know how it ended several years ago. So it really depends what your goals are.
Great, Yelena. Thank you very much for sharing your views with us on the US housing recovery. It was a pleasure to have you on the show. Now, viewers, make sure you stay tuned to DukascopyTV for the latest financial news and updates. But for the moment, goodbye.